Annyeonghaseyo. My name is Zach Lewy. I founded Arrow in 2005, and I'm CEO of the business. We're a very relevant servicer and investor in the European financial markets. We service 65 billion euros of banking assets and real estate and credit assets across Europe. Today, I'm going to give you an overview of the European banking sector and why there are interesting investment opportunities in that market. Turning to page 2, what you'll see is that the European and US economies are roughly the same size at 17 trillion. But there really the comparison ends, and the configurations of the two different banking sectors are very different. Europe has more than 3 times the amount of banking assets than the US does. That's because Europe is split into the 27 EU countries and 44 countries overall. And so you have a complete fragmentation of local language, local customs, local regulation, local client relationships. And so in practice, it's very difficult for European financial institutions to drive the scale required to actually run in the same efficiency ratios as their US peers. It's also the reality that European banking institutions struggle to build the large pools of homogeneous assets that are needed to feed capital markets. It's obviously much more difficult to create securitizations when you're splitting everything into 44 different countries, sets of laws, and asset bases. And therefore, Europe is a much more on-balance sheet banking market because the pools are too small as a generality to be distributed as a risk transfer to certain investor types. They wind up staying disproportionately on European bank balance sheets. And that capital-heavy European banking model drives the rest of the industry formation and industrial organization of the European banking space. You then further see on the slides that banking revenues on a per unit basis lag the US, albeit the sector is very, very large as a percentage of GDP. You also have a large number of banks, the fragmentation of the banks, and a large set of credit losses, which are exacerbated due to the balance sheet heavy model of European banks, where those losses stick to the European institutions instead of being transferred throughout the system. That creates a difficult performance environment for European banks, but a very interesting investment environment for outside investors like us and like hopefully yourselves, to look to make opportunities by helping reform this sector by buying assets at attractive prices. If we move to page 3, you see a further set of challenges for the European banks. When you have 3 times the amount of balance sheet assets, you're very dependent on the net interest margin. You're really selling your balance sheet as your primary way of doing business. With the average net interest margin in Europe being 1.1%, sitting in a very yield-constrained form versus a base rate of 0, it puts European banking institutions under tremendous margin pressure. And it's difficult to see that unwinding anytime soon. Whilst interest rates may rise, the structural position of European banks is being very dependent on capital and starting from an extremely low base of negative yields in many of the European countries. When you look to the bottom of slide 3 on the bottom right, you see that many of the key metrics are inverted to how you'd want them to be. You see that interest income has fallen by more than 30% in these institutions over the last 10 years. Conversely, costs have remained very sticky. And so given the labor market of Europe, it's difficult to get the expenses out whilst your revenues from net interest margin have fallen to a reduction of return on equity in the sector to 7.2% on average. When you think about the risk of a bank and the high levered equity position due to banks having significant embedded leverage, earning only 7.2% for taking the bet on levered bank equity feels a very skinny return for the risk profile, particularly given the history that these institutions have suffered significant losses in the past. You then think about it, and normally what you'd expect to see if there's 6,000 banks and a low profit environment is that you'd have consolidation. You'd be in a position where through M&A you could squeeze out efficiencies. But in Europe, there's very little banking consolidation. These business models have sufficient challenge that M&A has not been a major factor. It's also the case that buying banks in the different European countries comes with significant integration issues given the different languages and local regulation. Therefore, this problem is quite structural, and hence you will see it continue across multiple business cycles, not just single moments in time. If you move on to page 4, you'll see the composition of the banks. On the right-hand side of page 4, you see that the banks are fragmented into many different countries and a huge number of banks per country. This makes it, again, very difficult to drive efficiency. Historically, there was very considerable political influence in which banking was a very local business. That remains the case. It is often the case that, for example, the best auto lender in Portugal doesn't even have an operation in Spain, and outside of Iberia, no one's ever heard of them. This local fragmentation leads to even more challenge to find an efficient market. If you look at the NPL ratios on the left-hand side of page 4, what you basically see is that there are considerable loss rates. When your interest income is only 1.1%, losing a headline significant percentage of your asset value very quickly puts you into negative equity positions. And therefore, the loss absorption capacity of these European banks is very restricted. As you see, these loss rates are extremely high, higher than the net interest margins, higher than the returns on equity in many of the countries, and thereby creating another structural challenge to profitability in many of the banks. And you particularly see across Italy and Portugal and Greece why Southern Europe is plagued by this problem and is a very active investment market for investors like us who can help with the regulatory position that's equivalent to banks, but with an operating model and with a capital base supported by LPs and other investors like yourselves to step into the shoes of the banks and deliver great service to customers, but make good returns, having the strong hand to buy when these institutions are in a difficult position and need to sell throughout the cycle. If we turn to page 5, you see some other trends that are leading to the market opportunity and why it's a sustained long-term one. As you see on the first graph on page 5 on the left, there's a continuing decline of net interest margin and continuing declines of margins in total working with consumers. And it is really widespread across the markets. These banks don't have sufficient operating efficiencies, given the fragmentation of the European market, to drive positive returns on equity when your headline return on assets is so low. When you look at the middle of the slide, you see the historical 25-75 range of returns for European banking institutions. And what you see is that it is a stubborn lack of profitability. Even though we're 12 years post the last financial crisis in Europe, you still have a position where banks have struggled to get returns on equity out of mid-single digits. Given their risk profile, that's really an unsustainably difficult market. And again, you look on the right-hand page of page 5 and you see the consequence, which is a need to sell assets. It is really a dire position and it will struggle to allow Europe to grow. But given the size of the European banking market is 3 times larger than the size of the US, this need to sell assets to make the financials work is an exciting opportunity for investors like us to participate. As you see on that right-hand slide, the light blue box is where they've grown assets and created new asset origination to perform. But the lack of capital availability, the struggle with profitability, and also the struggle with efficiency has forced an agenda that's leading to delevering. Obviously, in a sector where there's a structural reduction of assets, the dark blue box, which is bigger than the light blue box, the dark blue representing the asset sales versus the light blue of asset growth, you see why people in our industry are focused on this sector, given its size and its structural trend to sell down assets. And given all the profitability constraints we've discussed, we expect that even before COVID to be a continuing theme of the sector. If we move to page 6, what you see is the different ways in which investors like us can get involved. As things like Basel III, Basel IV, the NPL statutory backstop and other bank capital ratio provisions force the sale of assets, you see those assets manifest themselves in very familiar sectors across countries. So you'll see opportunities in buy-to-let, single name bankruptcies, certain types of commercial real estate lending, certain types of specialty mortgages, some unsecured portfolios, and you'll see different opportunities in different, what we call niches, high value niches, for investors like us to create the local champion, the market leaders, to operate in the small sectors of all these different 44 countries where the banks can't operate efficiently. And that is the really exciting opportunity for investors like us to be really market leaders in the areas where the banks can't perform adequately. If we move on to page 7, what you basically see is feedstock into the non-core and non-performing banking market comes from multiple sources. On the left-hand side, you see the growing provisions the banks have made for non-performing exposures. On the right-hand side, you see the historical levels of asset sales, topping 80 billion euros in a single year, for example, in Italy, and back in 2018, you see this very large historical set of sales. If you assume, which is an optimistic assumption, that those investors have already recovered half of all of those amounts on the right-hand side of slide 7, and you assume that they can do it all within 6 years, which given the timelines in Europe is an ambitious assumption, they still have 40 to 50 to 60 billion that they need to sell per annum to deal with end of fund life issues. That creates a very vibrant secondary market for assets that have been sold but not yet resolved to coincide with the primary market where feedstock is growing. That's leading investors to raise considerable sums to play into what is a structural opportunity. If we move to page 8, you'll see that COVID has only made that situation worse. So there's been up to €1 trillion of additional market opportunity before COVID, combined with about $500 billion of losses that have occurred and been provisioned for at various points during the COVID years of the last couple of cycles. And therefore, you could have a considerable loss ratio, which particularly in small business loans, certain types of mortgages, certain types of consumer lending, will leave some of the countries in Europe exposed to very considerable additional strain in a banking sector that doesn't have the resilience or the robustness to absorb it. And that calls for even more capital requirement from the buy side to be available to acquire assets at attractive prices. If we move on to page 9, what you'll see is how that leads itself to a very interesting structural opportunity. So these dislocation events, the great financial crisis in 08-09, the Eurozone crisis in 2011, and more recently COVID, create these large dislocated asset bases. But the opportunity to invest intelligently in Europe doesn't even rely specifically on those dislocation events. Just the structural nature of the banking market being fragmented and inefficient creates interesting opportunity for investors like us across all of those little local champion opportunities where small parts of the market are not served by the banks or served very poorly, and the opportunity to invest and create market leaders in those activities is very robust. If you put on top of that the regulatory pressure to hold adequate capital for things like climate change and all the different important initiatives that Europe needs to prepare for, it creates an even more structural opportunity. And therefore, for really decades to come, with all the difficult reforms that follow, we would expect a deleveraging cycle across European banks with a need for investors like us to participate efficiently where the banks cannot. And we think that's a very exciting investment opportunity for now and for many, many years to come. With that, I will invite Cameron Anwar, who is our head of client and capital formation, and Jinhae Park, who is our senior advisor in Korea, to be available to you to answer questions. I'm sorry I couldn't be there with you today, but I hope to meet you in the future. And with that, 감사합니다.